This episode is brought to you by Tegus, the future of investment research. If you follow my newsletters, you know that Tegus is one of the things I use most often. Almost every post I have has some clip from an expert call or some quote from a management transcript that I've got off BMSEC that, it's because of Tegus that I've got access to all of that. It's revolutionized how I get up to speed on new industries and companies. I've been a happy subscriber of it for over 3 years now. And I tell you, I use probably every day I'm logging on to Tegus to look at an expert call transcript. And I certainly know, my BMSEC, I'm glad that it's unlimited because I am looking at BMSEC all the time. I'm looking at my Google Chrome right now and I have 30 tabs open and I'd say 18 of them are from BMSEC. So between Tegus and BMSEC, I am a very devoted user here. Look, it's one platform where you can dive into expert call transcripts, management checks, panel calls, and detailed financial data. No more fragmented data sources or endless searching. Tegus brings everything together, giving you a crystal clear view of the industries and companies that matter most. If you're ready to supercharge your research, visit tegus.com/value. That's tegus.com/value. Trust me, once you've experienced Tegus, you won't go back to your old way of doing research. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on my friend and the founder of Rangeley Capital for his monthly State of the Markets, Chris DeMuth. Chris, how's it going?
It's going well. Thanks for having me, Andrew.
Thanks for coming on. Happy to have you here. Before we get started, let me just remind everyone a quick disclaimer that nothing on this podcast is investing advice. That's always true, but maybe particularly true today because Chris and I are going to be doing our State of the Market. So neither him nor I really know what we're going to talk about. We're going to talk about a lot of different companies, a lot of different topics. Just remember, you should do your own due diligence, consult a financial advisor. Chris and I'm laughing because we were talking about, Chris recommended Xylem Hulk to me, which is used to clean your insides out, let's say. So I was going to say we might be talking out of our butts, but the fact that we were just talking about Xylem Hulk gives that a whole new meaning. So Chris, it is the end of July 2024, the classic thing, everybody says, oh, nobody's around in the summer. There's no need to pay attention to the markets in the summer. Maybe true, maybe not true. Definitely not true this year because it has been a rip-roaring July. But I just want to turn it over to you and ask what's on your mind as we kind of head into August.
Well, on the topic of Xylem House, not only is this not investing advice, it's now not investing advice or medical advice. Although one of the questions we got preparing for the podcast was today going to be investment advice? And I was trying to come up with a funny, sarcastic way. And I realized we don't want to be in court sometime explaining I was joking when I was going to say, no, this is not investment advice. These are investment promises. So if anything ever goes wrong in the future, just come back to us. These are guarantees. And I was going to come up with some way to make that a joke. And I'm like, you can't joke about that or you're going to be quoted back. So yeah, not investment or medical advice. But you should take Xylem House. Okay, so lots going on. Yeah, goodness. M&A, pre-arb takeover battles, everything from small cap value working, small banks and regional banks working, bank M&A. The world's changing, active, exciting, busy, exciting July 2024.
So I think there are three places you and I were talking about before the podcast we could start, and I'll give you your choice. We could start, you just mentioned it, we could start with just bank M&A and banks I think are in a very interesting spot right now. We could start by talking about that. We could start by talking about, there are two activists kind of special situations I think are really interesting right now. One is RCM, which I published a blog post on. I'll include a link in the show notes. I published a blog post maybe 2 or 3 weeks ago, link in the show notes. And then the other is Wide Open West, where I literally, right before we went to record, we sent a letter to the Wide Open West board. We can talk about that. So I'm happy to talk about any of those three if you kind of want to choose which one you want to start with.
So I think we should start with pre-arb, just kind of thinking logically okay, we're doing pre and then we can do the currently announced ones after that, and then maybe focus on financials, banks. I'd like to mention insurers as well. But so maybe, so RCM, if that would be a nice one to kick off with, has bids due Wednesday, tomorrow from as of this recording. So it could be right around the time, or maybe even by the time we could be predicting things that are incorrect by the time this is out to listeners. But so right around a key part of that process. It's very interesting. It's kind of like I don't know, game theoretically, it's almost like a three-way game of chicken with costs and benefits, or risk and reward consequences created by kind of all the players, the company, the controlling shareholders, that really affect any kind of strategy. Really, everybody's moves affect everybody else, some of which has been projected, some of which hasn't been projected. It makes it very hard to just do a kind of traditional sale process, because there's positive and negative control in bits and pieces divided between different players. I think very, very interesting situation.
So if people can go read the blog post again, it'll be linked in the show notes for history. But after that blog post last week, you and I are taping July 30th, which will be important for people who are listening to this to know in a second. But last week, RCM comes out and they say, hey, New Mountain, one of our 30% shareholders, has bid $13.25 per share for us publicly. Towerbrook has publicly said they are partnering with CD&R to make a topping bid to that $13.25. And last week, July 22nd, RCM says, hey, we're setting a deadline. July 31st is the deadline for bids. And this has been an area of very hot debate among investors I talk to, right? Why did RCM set a July 31st deadline? Because A, that's a little tight. Towerbrook and New Mountain have both been involved with this company for years, but CD&R is apparently starting from zero, right? They're the new equity partner for Tower, so they might need time to get in there. And people have kind of been like, why would RCM set the deadline? Like, is this an indication that neither side's really ponying up? Do they think a tighter time frame benefits them more than a longer dragged up? Like, what do you think the reason for setting this July 31st deadline is?
Get a sense of urgency, get a real contract, get something that's ironclad. If there's a later bid, you can always come in later, unless there's like a big breakup fee or there's some quantitative reason why you can't do it. I always think it's funny when somebody's trying to control a process, whether it is a banker or even you'll see it at the retail level with a real estate agent. The realtor will say, like, your bids are due on this day. It's like, what, if I offer 5% more, you're gonna, you're not the Pope. There's not like infallibility. You're just some person saying something, and you can always kind of violate the intended process as a participant if you have something that's worth listening to. But in theory, I think sense of urgency. Also, in game theory, there's some interesting strategies where you don't want to hear certain things. Like, you want to make yourself unavailable for being held hostage when you have somebody who could come back later and say, well, you might want something signed, or you might want something concrete before one of the players that want to be a bidder gives you an ultimatum, refuses to sell, kind of disrupts the vote, does something clever. One good reaction against cleverness can be to refuse to listen to it or to disrupt it by going too quickly. So I think it probably makes sense. Get something signed. I mean, I love sign a deal with no breakup fee, or sign a deal with a low breakup fee.
So, the negative I've heard from people has been like, it's not lost to me that the company would report earnings probably like around August 7th ish. I don't know the exact day, but July 31st, you put that deadline out there, and some people have come with the negative, like, hey, do you think they're doing this because there's historical, like some of their customers got hacked, there's these operational turnover issues? Do you think they're doing it because they need a bid before like the rug gets pulled out for them for earnings?
But you can't deny that information to the bidder, though. That's
exactly. That's kind of been my thing. I'm like, look, I understand what you're saying, but these bidders, like, you look at the 13Ds, they each have board members not only on the board, but more board members who they've pulled off to like help them with due diligence. Like, I'm sure they know what Q2 earnings are going to look like. And it's not like you're going to sign a multi-billion-dollar deal and then be like, we were surprised at like earnings, which, ended a month ago. So I've heard that. I have wondered if it's like, if the earnings report would come a week after that deadline, it does line up nicely with, you get final bids, you negotiate a definitive agreement, and you kind of announce it alongside earnings. I have wondered if there's like a less like tinfoil hat, but there is something to that. On your game theory point, I think that's really interesting, because I've had this debate with people, right? They've said, hey, what does a July 31st deadline really matter? If Chris bids 15 And then on August 1st, I see Chris bid 15 and I decide I want to go to 1550. Why don't it like, and my answer is yes, you can top after July 31st, obviously. But the two things you're going to run into are, one, if you come too late, Chris will have signed a definitive deal and there will be a breakup fee. And the breakup fee will be tens of millions of dollars, which will be, 30, 40, 50, $1 per share. So you're going to have to pay that. And then two, the board does have a right to consider likelihood of close, right? So if they say final bids are due July 31st, and then August 1st, you kind of come running and saying, I object, he's paying 15 and I've got 1550. Well, the board can say, look, 3% more is not worth it for us for certainty of close. Now if you came with 1750 versus 15, maybe they have to listen, but 3% more, we gave you a deadline, you couldn't meet the deadline. We're allowed to consider certainty of close when we're doing this, and we're late stage negotiating the documents. We're worried if we stop those negotiations, maybe you pull out. So that's kind of how I've thought about it, but it's really interesting because I can't really remember a company publicly saying, here is the deadline for bids. I mean, I can't remember two 30% shareholders bidding against each other for a company, but can you remember a time where a company said, here's the deadline for bids?
Not this exact situation. It's funny, as you were mentioning those numbers, those were precisely what I was thinking in my head was, if you thought there was any innuendo from bidders, especially that it's a little bit like monopsony pricing, right? Who the players are at this point. And if there was any innuendo that's I want to buy it for 1750, you want to buy it for 1750, can we kind of somehow get it towards 15, not towards 20 by our coordinating? And if you're the seller, you want to speed it up to give them less time. You're like, hey, maybe you heard that they were going to meet down. Maybe you're talking to people there and they're like, oh yeah, we're talking to them in a few weeks, or a few days, or we were talking, any innuendo of communication between the bidding parties, because they know who each other are and they prefer, so if you just kind of added up all of their different preferences, it could be to buy it for 15, not 20. And if you want to sell it for closer to 20. And I think high teens is possible, mid-teens is possible. I'd be surprised if it's less than mid-teens. I think it's going to sell. And so you have this kind of non-transitivity, and I think rushing it might be one way to just give less time for coordination.
Yeah, no, I do think there is something to that, though. In this case, when I go back and reread a lot of the documents, look, you've got two 30% shareholders, right? It would always make more sense for them to work together to bid, because then they can pay less, right? You're removing competitive tension. And by the way, two 30% shareholders together have a blocking stake over everyone, no matter what. In this case, they have decided to divorce each other and bid against each other. So I kind of have started looking at this and saying, I think there is a lot of bad blood here. And another reason I think the company might have put out a tight time frame is they've been okay, you two kind of have irreconcilable differences. It's better for us to rip the Band-Aid off, get the best bid, and get this sold now than it is for this to linger. Because I think part of the irreconcilable differences is very different views for strategy. You and I are running a bank. You want to turn it into a hyper growth bank. You want to go do national M&A. And I'm over here saying, hey, we're going to run with a fortress balance sheet and we're going to pay a dividend and we're going to go golfing. We're going to be at the golf course every day. Those are irreconcilable differences. And I think not that one of but I think one person wants to go much more tech heavy. One person wants to go more Salesforce heavy. So I think it might be they're trying to rip the Band-Aid off here and get a deal done early. And yeah, I don't know. Anything else on RCM?
No, just of course, they're rolling over equity to pay us cash. So we're just trying to get the biggest number possible, honestly, with the best speed, IRR, and certainty. But assuming a deal could close, that's the end of our interest and the beginning of theirs, right? So their strategy for after they buy this is this hugely topical thing for them in a way that it's not really for us. If they come up with something that's plausible, cool, just pay us. And so, I think that's what a lot of going on behind the scenes is right now.
I mean, look, this can look foolish really quickly because, again, we're taping this July 30th. The deadlines are due the bid deadline's July 31st. I doubt we hear August 1st, the sales numbers, but we'll know quickly. So this can look really foolish really quickly, but I'm used to that. I will just say, like, I've never seen a public bidding war between two kind of majority-ish bidders like this, and I just remain shocked. The stock, as you and I are talking, $12.75 per share. New Mountain's bid was $13.25. Talbrook put in a 13D that they said we're going to top that bid, and it seems we've got a bidding war. And I just remain shocked. I don't understand. It's an N of one. I just kind of don't understand what the market is thinking. I'll disclose, like, if it wasn't clear as we're talking about it, we have a position here. We'll either look very foolish or sort of smart in a week, 2, 3. But that's the disclosure. Like, I'm just very surprised by the whole situation. Anything else you want to talk about with RCM?
No. How about WOW?
WOW. Well, we'll just start with the disclosure that we're also long WOW. I published a letter as kind of you and I were going to tape, but I'll flip it over to you on WOW, and I'm happy to add anything on that.
No. You should start with this. So, I was going through the letter right before. Let me see how to phrase this as a question. What does charter mean for WOW, and how does that affect its value? How does it affect the kind of dynamics of the situation?
So, I guess just to step back slightly, in early, I believe it was May, Crestview, which owns about 30% of WOW. It's funny, 30%.
So similar situation.
Similar, except RCM has two private equity firms that are in 30%. But Crestview made a bid for WOW at $4.80 per share, which they said was about from memory, about a 30% premium to the unaffected share price. And we published a letter to them in early June that said, hey, look, we understand. WOW is a small levered cable company. It's probably too small to be public. They've sold assets since they've gone public. It's probably too small. Nobody cares. It's the only cable overbuilder that's publicly traded. We get it. Being public is expensive. But even at the 30% premium that Crestview is offering WOW, this would be the cheapest telecom, forget cable, this would be the cheapest telecom M&A that we're aware of in the past 10 years. And look, maybe there's some small deals or off-market deals that we're not aware of, but the overarching trend is this would be cheap. And that alone is damning, but it's even more damning because we're including copper deals in that deal set. So, WOW is a cable play. Cable has a long future ahead of it. You can get gigabit, 2 gigabit, 10 gigabit data speeds using cable. Copper does not have a long life. That is declining. That is basically AOL dial-up. You can get at max 25 megs from copper. Go look at any copper player. Frontier is publicly traded, and we have a small position there. They actually disclose their churn, and they're losing 10, 20% of their customer base every year because nobody wants copper. They want cable or they want fiber. So we said, hey, you're selling at the cheapest multiple in our telecom database, but you're selling a better asset than those cheapest multiples have gone to. If you go to cable assets, they all sell for much better. So we said you need a bump. And then I guess the reason I published the updated letter was Charter reported results last Friday, and Charter stock was up 20% on the results. If you look since the Crestview bid, Charter stock is up 40 or 45%. So Charter stock is up more than Crestview's premium over the unaffected price. And all of the reasons that Charter has done well apply to WOW. In fact, they might apply to WOW more. So we were just saying, look, everything we said in our first letter remains true. And on top of that, the environment has gotten much better. And look, if Crestview wants to offer a full and fair price where they can make a good return and we get paid fair value for WOW, we completely understand going private, but the full and fair price is a lot higher than the initial price. It's a lot higher than, in my opinion, the market price. And if they don't want to do that, I think WOW should consider selling themselves to the highest bidder and or just starting to run a capital return model. So I rambled a lot. I'll kind of toss it over to you.
Financial bids always have a self-help public market version of it. And I've always thought you should have this in proxy battles where you could have a vote to simply try to do it yourself, right? You can do it, you're right. Like this is the separate topic of who's the best owner from what is the optimal cap structure. If you're not
one of the things I hate. I'll talk to companies. They'll be like, hey, you're levered 2x. Why don't you go to 3x to buy shares? And they'll be like, oh, we can't do that as a public company. We could do that as a private, but not public. And be like, why can't you do that as a public company? I understand your stock would be a little more volatile, but if you think that's the optimal leverage level, why can't we do that as a public company? Why can't I get those returns instead of KKR or Digital or whoever you want to name?
It's most infuriating when it's MBO, right? When it's like, hey, we can do it the bad way for your money or the good way for my money. And I'm like, wait a second. Wait a sec. Why don't we do it the good way for the poor schmucks that already owns it? So it's different when you're talking about a strategic deal, when you're talking about cost savings and the other things people say about M&A that work, but especially when you're talking about cost savings. Okay, so part of the premium you're getting paid is you're getting handed back some of the money that they're going to be able to take out of their cost. Yep. That's a different topic. When you're just talking about a presumably smart, self-seeking person who can do arithmetic and likes making money, they're looking at this company and they're doing very similar work to what you're doing. And they're saying, like, in a sense, you both agree, they just want to be able to underpay, and you're noting that they're underpaying or offering to underpay at this point. So it's possible to do it in the public market. It's possible. And I've always thought that every deal, my reform would be even on the buyer side. So if you're offering to do it presupposes that there's capital available to do things. Can you at least say versus buying back your own shares versus doing a self-help or like levered recap or something? You could do other deals in the public market as well as private that presupposes, hey, the public market doesn't want like value correctly this thing, which is kind of the unspoken assumption behind offers. And so the easy way is if they want to own this, just pay the right price. Or the company can find somebody else willing to, because there's nothing really special about a financial buyer, right? There's a lot of capital, and you kind of get to free ride off of the IP that they have assertively thought that it's worth this. And so maybe it's worth it to somebody else. Maybe we can find somebody else who would pay slightly or a lot more. And then you have things changing because of charter and kind of the environment improving since then. So it's conceivable you have one bidder that had this amount of money or had this scale that they presupposed they were going to do. We can find somebody else who has deeper pockets.
And again, look, Crestview owns 30% of the equity here. They've historically had this as a private company. Mm-hmm. I have had debates with people on if WOW's debt is portable to just Crestview or to any bidder. But I guess what I'm saying is, look, if Crestview offered, I'm picking a number. I'm not saying this is fair value. If Crestview offered 10 versus if another party offered 10.50, like you could make arguments you should go with the Crestview bid for certainty, for speed of close. Like they've gotten regulatory approval from the cable regulators state by state before. Like I completely understand that. So there is a little bit of a kind of tie or even slight loss goes to the incumbent party. But again, if they want to pay, their initial bid was $480. I think it laughably undervalues the company, as I kind of discussed earlier. If they say, hey, we want to go to $5, they need to go run a full process and try and find a bidder. And even if they can't, even if every other bidder's like, hey, we don't want to risk a 30% shareholder voting us down, or, now's not the right time, cable's still kind of depressed. The board still has a duty to say, hey, we're not going to sell at all-time low multiples just because our majority shareholder wants to take us private for a song. Like we can do a lot of the things that they're saying they want to do. We can do it ourselves and return capital. You know which one was interesting? Just again, we've got a position here. I've talked about it recently, but Bally's, BALY. Just last week, they announced their majority shareholders buying them for a large premium. But what's really interesting there, I've never seen this before. I'm really interested in how it will work. We haven't seen a proxy yet, so we don't know. But they said, hey, we're going to buy you for $18.25 per share. But as part of that, if you are a shareholder and you say, hey, I see what the controlled shareholder sees here. I think there's a lot more value here. I want to roll my stake. They're letting shareholders roll their stake. And like with WOW, I would be kind of interested in saying, hey, instead of $4.80 per share or $6 per share, here's the bid. But also, if you believe in the value, you can roll. Now, there's lots of other questions here, but I've never seen that before, and I'm pretty interested in it. I wonder if that's the start of a mini trend.
I love it. I think it's kind of rational, logical, and it's kind of revealing. It lets people act in their preferences, and it makes it less contentious in some way, right? If you have this really strong thesis and you're a relevant player with a relevant player scale, You think, oh, the price is really high or low. It lets you act on it either way. You can be a buyer or seller. No, I think it's a great way to have a market.
And there are questions like I do want questions around, hey, are the control people getting management fees? Are they like, how does the role process work? But it does kind of solve the issues where if I'm going to forget WOW, just any generic company saying, hey, you're selling to your majority shareholder too cheaply. If they offer, okay, we'll let you roll it on their terms, then it's kind of to me like, hey, are you willing to accept the illiquidity, the long term? Like you can invest at the exact same prices. You're saying there's still like, if you think it's taking advantage of people, you can join the taking advantage of all the people who want to cash out for cash.
And then, I mean, the other two things you kind of see here is there's always this kind of risk aversion behind management and boards in that even if you have a very concentrated portfolio, you might have a dozen different things, but you're the management or board, you're pretty much like, this is your one thing. You kind of don't want to screw it up. And you tend to, I mean, there might be some animosity and frustration, but you tend to trust more these large concentrated holders you just know well. So like, I think that I think RCM is going to sell, and I think Wide Open West is going to sell, and I think it's going to sell to the obvious people. I actually don't think it's going to end up being some other kind of exogenous force here. I think it's going to be kind of the most obvious thing that's going to happen, but it's partly just like the human element of the people you're dealing with anyways. It's kind of the natural conclusion of this. It's our job to make sure we get the best value, and I think we will. But there's this kind of this natural inclination just to deal with the people you know.
You know, there is something. WOW and RCM also both have another interesting thing. Like WOW, when the initial bid came out, was the worst environment sentiment for telecom and cable stocks I think I've ever seen. That's improved a little bit, in part thanks to interest rates, in part thanks to the operational performance, all that sort of stuff. But you know, WOW, when they did that bid, Crestview, when they did that bid, having DigitalBridge as their partner, I personally thought was very reassuring and very value affirmative, because DigitalBridge is a digital infrastructure fund, right? So they own towers and fiber players and everything. And the fact that they were looking at this saying, you know, they're not in this for charity, that they were saying, hey, if we buy 60% of the WOW equity at $4.80 per share, we think we're going to realize private equity returns. Like that's pretty affirmative. And then RCM, you know, there's been an active short case on RCM. There's been a lot of angst over, as I mentioned earlier, some of their customers had issues with hacks. Customers and suppliers had issues with hacks that are causing short-term noise in their financials. And the fact that you had at the time one, and now it seems like both of their kind of majority shareholders are saying, we see the value here. You know, I do think there is, as a investor and as someone thinking about these deals going through, I think when you've got a majority shareholder who's got a lot of info on the company that probably you and I don't really have, and they're kind of underwriting saying, yeah, we think we're going to get really attractive returns at this bid level. I think that's also a really interesting value signal. Yeah.
And in one case, we wrote a public letter. In the other case, we didn't. But in both cases, it's like, there's nothing untoward here. It's like they're being opportunistic. I mean, it kind of, the timing really checks out that the people who know the most would be trying to pick off the right time to get a low ball deal done.
It would be really funny if one of these guys filed a bid and we're like, hey, you know, we're bidding $25 per share, a 50% premium to the unaffected price. And we're doing this not because we think the company's cheap. We think the company's way too expensive, but like we want tax write-offs. Or this is our, you know, some people donate. Some people donate to children for charity. We donate to minority shareholders. Like that would be a kind of funny one. Anything else on WOW, RCM, take privates, anything?
Pretty straightforward.
Let me go. I just want to go to one thing that's been on. Let's talk banks. And we've talked banks several times on this podcast, but you know, one thing that's been on my mind, and I'd love to get your thoughts because I know you talk to a lot of banks as well. Over the past, since kind of Silicon Valley and First Republic fell, and even before that, but especially since they fell, you know, banks have been in a tough spot. Short-term interest rates were and are higher than long-term interest rates. You know, the yield curve's inverted. And a bank traditionally, what do? They borrow short to lend long. When the yield curve's inverted, that's really tough, right? So as you and I are talking at the end of July, like we're kind of finally have line of sight into the Fed cutting interest rates. The yield curve is kind of starting to uninvert. And banks have responded really quickly, right? Every bank has ripped. 2 months ago, I could have pointed you to a ton of banks that were trading for 80% of tangible book. And today it's really hard to find that. But I just think it's interesting in terms of the outlook for banks, and particularly over the past 15 months, there hasn't been a lot of bank M&A. So I just want to ask you, like, what do you think about the outlook for banks? What are you hearing from banks in terms of M&A, their appetite for buying, selling, all this sort of stuff? And because also, this administration has not been, it's been very difficult to get bank mergers approved under this administration. The possibility for a change either to a Harris administration or a Trump administration, like, I think that's interesting in bank outlooks as well. So I threw a lot out there. I'll toss it over to you.
So clarity always helps transactions. And so not only is the environment getting better, but it's getting less kind of amorphous. The environment's one that the boards and managements presupposed when they set up their books, the risks that they are taking is much closer to the risk they thought they were taking. So it's kind of like, unsurprisingly, they thought that they were doing good things, but they're also doing things that they have an easier time valuing. It's a much, much, much better time for doing deals. Because you'd think bad news isn't necessarily bad for transaction, especially like a stock for stock deal. You could always have something, if we want to do a deal and your value is cut in half and my value is cut in half and we're doing equity, that should just totally check out. It's not, there's no arithmetic problem with that. In practice, there's all sorts of human problems with it, just being annoyed at getting bought for way beneath your recent high. Again, totally arbitrary, but like it does affect actual psychology. So much better environment. There's going to be a ton of deals. Can
I just pause on the recent high? The recent high point you make is interesting because every bank dropped in March to April 2023 quite a bit. That's when Silicon Valley and First Republic was happening. Yep. And now you and I are talking end of July, like that's in the rearview mirror, right? That your 52-week high is no longer pre-SIVB, it's post-SIVB. And I do think that makes a difference when you're negotiating, talking. People have kind of adjusted maybe to a lower stock price level as well.
The kind of mid-twit meme of the bell curve, the dumbest kind of just first order observation about like the stock price shouldn't matter at all. And a mid-twit person might say like, oh no, that's why it doesn't matter. But it actually does matter when you're dealing with boards and management, like the people who make the decisions, they do kind of care about this stuff. Now, sometimes they have personal, comp that's related, whatever, but they mostly just want to feel smart and they don't have to do something. And you kind of want to retire, but you might hold your breath because you think this too shall pass and you get a better price. And that kind of thing does make a difference in how these deals are timed.
It all makes a difference. It also makes a difference. You put in a proxy. If you put in, hey, Chris offered $11 and that is a premium to the 52-week high, that sounds a lot better than Chris offered $11 and that is, the 52-week high was 17. And it doesn't matter that, there's been a nuclear winter since the 17th to today. This is a huge premium. It's a great price. Like you no longer can say in your proxy, it's a premium to the 52-week high.
People making money are happy, even if you make them 20% and sensible decisions should have made them 40% and you were kind of, botched a bunch of things, they're still going to be happy, less litigious, and there's not really quantifiable damages. And if you lose the 20%, but you were brilliant, you were just this wonderful, anything should have said you should have lost them 40%, but you managed things so well, they're still pissed. Because they're poorer, even if you did a really good job. So, and the damages thing, that is it's harder in court to come up with you should have done even better when you've done pretty okay.
Companies have this defense too. There are a few companies where I've done, and I just think the management teams have done just abysmal jobs, abysmal, right? But the stock has gone up 20%, right? Which 20% is a nice return. And I just think the management teams have done an abysmal job. Peers are up 50%, all this, but it's hard. I'll talk to other shareholders, be like, hey, this management team, they're building their pricing strategy, they're underpricing, whatever you want to say. And other investors just kind of like, we're up 20%, man. Yeah. Don't care. Whereas if they're down 20% and every peer is down 98%, you talk to another investor and be like, this management team, let's get them out of here. Like, let's tear them apart. And you're kind of like, well, yeah, maybe I think they could be better, but it's a tough environment. But it is funny how management teams can be a rising tide, lifts all boats, but it also kind of protects the management team.
Yeah, exactly. So, let's see. I forget if I mentioned this last time, but a lot of an increasing, and even if I had mentioned it even more now than a month ago, credit union mutual interest in as buyers in MMA in M&A. You have kind of remutualizations, some announced, some in process, but I think that's going to be kind of a big theme in banks. You have the ESIP banks, I think, are going to be big kind of sellers in the M&A. You have, one kind of coming out saying like, oh, we're easily qualifying for the kind of very lowest pref payments, which would have a subtle range, and it looked like they were either very low or next to zero cost, and it's looking like more like the next to zero costs for the government funding that they got, so which makes them even more valuable. So I think that's going to be a big category, so yeah, I think we're going to see a lot of deals.
Look, I think we've been going for about 45 minutes. So we've hit most of the stuff. We can talk Chevron if you want, or we can just wrap it up here. Kind of up to you.
Let's see. Maybe we can talk next time airlines. I think we could have news on Hawaii, Alaska, and see kind of what the next shoe to drop is on airline antitrust. And it'll be interesting to see if there's a complaint against that deal, if and how Spirit is cited, given that Spirit is now raising prices and changing their business model and doing a lot of the things that the suit to block the JetBlue deal was designed to prevent. We kind of know the outcome in that in a lot of ways. We've had a history in the last few years of a number of, you could say, failed deal approvals that had failed divestitures, and this was in a sense a failed complaint or a failed block, or they didn't achieve any of the things they stated they were going to achieve by blocking it, and you already have that outcome that was kind of decisive and fairly fierce by the time they had to make their next decision. So these things will come in short order. So I think that's maybe a conversation for next time, but I think we're going to know a lot more in the next few weeks on that.
No, I just like what you said. Like, look, longtime listeners know how you and I feel about the Spirit Airlines JetBlue merger, but exactly what you're saying. Like, cool, the administration blocked it. They blocked that merger. Spirit's changing, like hundreds of millions of dollars are now going to restructuring lawyers, financial lawyers, all that sort of stuff that, I'm sure Spirit would have rather sent to their shareholders' pockets and then had JetBlue like implement all these changes. But Spirit's making the changes. Like, Spirit got blocked because they said it was a unique business model. But here's the thing about business models: whether you change them, JetBlue changes them, or the company changes them on their own, like they can change. It's not a asset thing. And I can't believe that merger was blocked. I can't say I've like eagerly inspected Hawaii and Alaska yet, but if Spirit JetBlue could get blocked, I think Hawaii and Alaska is just as likely a case. I do know I heard from people who were in the courtroom, who kind of were sitting next to some Hawaiian, Alaskan observers who thought that some particular aspects of that case that went against JetBlue were actually good precedent for them. But I can't say I'm a super expert on that case yet. But as you said, it seems likely that will be blocked, and it seems likely we'll be going to court on that case in the near future, unless we have a change in administration and they try to block it, and then the new administration says, Hawaii, Alaska, you guys do what you want to do. Cool. Okay, well, that's it for the July 2024 State of the Markets. Chris, looking forward to the next one. We'll talk before then. And thanks to everyone for listening.
Thanks, guys.
This episode is brought to you by Tegus, the future of investment research. Look, if you've been reading my newsletters, you know how often I rely on Tegus for my research. I probably read 1 or 2 expert calls a day, probably average 7 a week off of Tegus. They've got the largest transcript library in the world with over 75% of the private market transcripts. Whether you're curious about AI, biotech, or any niche market, Tegus has the insights you need. What sets Tegus apart is its all-in-one platform. It's packed with expert call transcripts, management checks, panel calls, and in-depth financial data. No more jumping between different services or piecing together fragmented data. With Tegus, everything is right at your fingertips. The best part, the insights you get are from the very people shaping the industries you're interested in. You'll find perspective from insiders and executives that you can't get anywhere else. To see Tegus in action and understand why it's one of my go-to resources, visit tegus.com/value. That's tegus.com/value. Trust me, once you try Tegus, you'll never look back. A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.